Let's talk interest rates this week. We're talking about the Bank of England's base rate for two key reasons. The Bank of England's Monetary Policy Committee will meet on Thursday to decide whether to cut, hold, or raise interest rates. Second, because Wall Street banks this week are making some bold predictions about how many times the Bank of England will cut its base rate this year. The base rate is currently at 4.75%, and most analysts expect a 0.25% cut to the bank's base rate on Thursday, bringing it to 4.5%. With 1.7 million fixed rate deals ending in 2025, interest rate changes will impact buyers, movers, and investors. So let's delve a little deeper into why Wall Street Bank's predictions might be right and why market sentiment matters more sometimes even than the Bank of England's base rate cuts, at least in today's economic climate. Have you ever wondered why mortgage rates don't always match the Bank of England's base rate? That's because banks don't just rely on Bank of England's base rate to price mortgages. They also look at something called the swap rates. The Bank of England might not adjust interest rates for months and is usually pretty slow at reacting to global events. But markets react every day to global events, inflation data, and economic data. These daily changes influence what we call swap rates, which banks use to set fixed mortgage rates. That's why, at times, you might see mortgage rates lower than the Bank of England's base rate. It's all about what the markets expect in the future. Now, if you want a super simple breakdown of swap rates, check out my blog. I'll leave a link below. Now let's talk about base rate forecasts. Morgan Stanley last week forecast 5 base rate cuts this year, with the base rate reaching 3.5% by the end of 2025. Goldman Sachs, on the other hand, forecast 6 base rate cuts, with the base rate reaching 3.25% by mid-2026. Finally, economists polled by Reuters 2 weeks ago forecast 4 base rate cuts, bringing the base rate to 3.75% by the end of the year. To put this into perspective, at the end of last year, markets expected just 2 or 3 base rate cuts, forecasting a 4.25% rate at the end of 2025. So what's changed? The Labour government's first budget in office has posed a big challenge for the Bank of England. The Bank of England has a tough job. It needs to keep inflation in check while supporting economic growth and jobs. But Labour's first budget has made things even trickier for the Bank of England. Their 25 billion national insurance hike means businesses have higher costs. And to cope, the businesses are likely to do 2 things: raise prices for consumers like you and me and cut jobs. That means inflation could creep back up whilst unemployment rises. Exactly the opposite of what the Bank of England wants to happen. On top of that, businesses will likely spend less on investment and expansion, which could slow down the economy even further. This puts the Bank of England in a tight spot. How does the economy grow and the unemployment stay low if businesses are not investing? The UK saw 0 growth in the last quarter of 2024, with forecasts for growth in 2025 under 1%, and unemployment is rising. With major companies like Sainsbury's and Tesco's already announcing job cuts, blaming the national insurance increase as the main reason to cut jobs, add to that, the business confidence is at a historic low, with Confederation of Business Industry, CBI, warning that businesses are already planning job cuts and raising prices further. So how does this all link to the Bank of England cutting base rate multiple times this year, you might wonder? The only real incentive the bank has to offer businesses to invest more and drive growth is to cut the base rate and encourage consumer spending. This might lead to high inflation in the short term, but Morgan Stanley in its forecast argues that the bank may not have any other option but to lower borrowing costs and prioritizing a stagnant economy over high inflation. So there you have it. Interest rates rose fast, but they could start dropping again soon. The big banks expect at least 4 to 6 cuts this year, but with inflation concerns and Labour's tax policies in play, it's not a simple decision for the Bank of England. What do you think? I want to hear from you. Will the Bank of England cut rates aggressively this year, or will it take a more cautious approach to things? Let me know in the comments, and if you found this helpful, please don't forget to like, subscribe, and hit that bell icon. Thank you for watching, and for any further information, please do not forget to check out my link for my blog. Thank you.